Well, we've had a week off here at Question Time. We're rested up. We're ready to go. And Steve Brennan has had lots of time to sift through your questions. Steve, what do you got?
Well, I got a great question, I think, for Joe. The Federal Reserve seems to have declared victory in defeating inflation that had absolutely nothing to do in its causation with them. So I was just kind of wondering if you could kind of give us an update on the Fed victory parade over inflation, Joe.
Well, this is the old correlation and causation theory. Just because two things happen at the same time doesn't mean that they're caused by one or the other. Look, I just find it fascinating that everybody pays so much attention to the Fed when the market's ahead of them all the time. You know, everybody talks about, well, the Fed was late hiking rates. The market wasn't. Maybe the market didn't go, rates didn't go up as much as they needed to, maybe. I don't know. But the bottom line is that rates went up before the Fed started hiking. And now we're at the end of this cycle, or somewhere near the end of this cycle, I suppose. Inflation has come back down. I don't know that it had anything to do with the Fed. The fact that inflation has come down. I mean, think about it. Inflation peaked a mere 3 months after the Fed started hiking rates. So rates went from 0 to 25 to 50 basis points, and suddenly inflation peaked. I don't think those things are related. Maybe I'm wrong. Maybe monetary policy is that powerful, but I don't think so. So yeah, look, the Fed's declaring victory. So what did they do? They raised rates, and what? How did that affect inflation? As far as I can tell, it didn't. I don't know that there's really a great argument that says, hey, the Fed was able to kill this inflation, because as the Fed acknowledged, and as Jerome Powell acknowledged in his speech at Jackson Hole, the inflation really didn't have anything to do with monetary policy. Now, I want to be real clear here too. When I say that, I don't mean that interest rates at 0 were appropriate. I don't think they were. I personally don't think that the Fed should be in the business of setting short-term interest rates, but I don't get to make that decision. But the bottom line is that short-term, very low short-term interest rates, which is really what the Fed controls, they have other impacts that are not necessarily positive for the economy or markets. And one of those is that you get a lot of speculation in financial assets and lots of things. There's a reason why people have invested a couple of $1 trillion in these in funny money called crypto. It's pure speculation, and we see it also in lots of different ways across the economy, from the gambling culture that we've developed over the last few years to meme stocks to all kinds of things. Those things are driven in some ways by monetary policy, but they don't necessarily have a big impact on inflation or deflation or disinflation. So I think the Fed was right to raise rates, but I don't know that it really impacted the price level. Anyway, look, where are we? Look, right now, what Jerome Powell said last Friday at Jackson Hole was, we're going to cut rates, and that's not a question. I mean, he essentially said, it's time. And the only question is how much. And he said that would be a function of incoming data and so forth. Which I don't know. I guess that makes sense. But all I will say is that the market will be ahead of the Fed at every step of the way. The Fed's talking about cutting rates by 0.25%. And guess what? The 3-month T-bill has gone down by 0.25%. It's already there. So we already cut rates. The 10-year note has gone from 5% to 370 something, 380 basically today. I would say that that's probably telling you that the economy, the nominal growth of the economy is slowing pretty significantly. Is that going to lead to recession? I don't know. It might. I don't know that the Fed, again, has any control over that. Everybody thinks they do. Everybody thinks they have control. And to some degree, that's kind of one of those self-fulfilling prophecies, I suppose. But the bottom line is I don't know that they really have much to do with it. So we'll see where the economy goes from here. I can tell you that the market will be ahead of the Fed at every step of the way, whether we see it expressed in the dollar or we will see it expressed in interest rates and short-term and long-term rates. And so we don't really need to care what the Fed does. Now, I will say the Fed can affect things in a way, but usually they affect them in a negative way. So like I said, you don't need to wait on the Fed. The market's already told you what they're going to do, and it's already incorporated into the market. People talk about the efficient market theory. Well, efficient market hypothesis actually does kind of work. And there's also the wisdom of crowds. Whole millions of people trading stuff ended up getting rates where they are today, as opposed to a small committee of people over at the Federal Reserve. It's not surprising to me that the millions are ahead of the dozen. So anyway, that's it. Yeah, rates are going to come down. Rates have come down. We'll see where they go from here. By the way, the market's kind of pricing in like 3 cuts by the end of the year. I'll be surprised if that's what really happens. I think the biggest impact that the Fed had with interest rates was on the real estate market, which has a knock-on effect to some degree in the durable goods orders and so forth. But if you bring rates down and mortgage rates keep coming down, you see more increased housing activity. That's going to cure itself, and so it'll be interesting to see what happens. But I wouldn't get ahead of it. Let the market tell you what it's going to do. And right now it's just saying a quarter point in September, and that's all you're going to get. And we'll see where it goes from there.
Be sure you get your questions in for Joe. Put them in the comment section down below.